Hello and good morning or good afternoon, depending from where you are tuning in. It's a great pleasure to welcome you to our webinar, Shining a Light on African Solar Energy, an outlook on the different market segments. I'm really excited today to be presenting to you our webinar with 5 really knowledgeable speakers. Before we go into the presentations, I would like to give you a very brief run through the webinar. So you know today's agenda. So my name is Ramses. I'm a project manager at Solarplaza, and I have the pleasure today to host this webinar. I'll briefly give an introduction, so the agenda for today. So after I've introduced the webinar, the organizations and the event for which we are hosting this webinar, I'm happy to give the floor to Farhan, Patrick, Abraham, Charlotte, and Paul. And we will approximately have 30 to 35 minutes of presentations. During the presentations, you are very welcome to share your questions because we will have a Q&A at the end. And then we round off the webinar in around in about an hour. So a very brief note. This webinar is hosted by Solarplaza for an event by Solarplaza and Gogla. Solarplaza is one of the knowledge and network centers in the PV industry. As you can see, it's our business and also our mission to accelerate the sustainable energy transition. We've been doing this for almost 20 years. And as you can also see, with a really worldwide scope, because although we are from Rotterdam, we've been organizing events in more than 40 countries worldwide and really all over the globe. So from America to Africa to Europe. And we are also proud to connect a network of 60,000 solar PV professionals. On top of our events, we also often create resources such as white papers or infographics or newsletters or webinars such as today's. During the past years, we've also opened the Solarplaza consultancy within Solarplaza, who is your solar partner for market entry and project development opportunities. The Solarplaza consultancy can help you to enter a new market, to build your position in this new market, or even to co-develop and acquire new projects. So if you are looking to expand, feel free to get in touch in the link that is shared below. On top of that, there's also the Solarplaza Foundation with the mission to accelerate the sustainable energy transition for all. Supported by several partners that are shown in the screen. The Solarplaza Foundation is really empowering projects, for example, through education and network building and financial contribution. Also for the foundation, if you would like to know more, feel free to get in touch with us, and we're happy to brainstorm or have a virtual coffee. This event is part of the content series of our Unlocking Solar Capital event. This is one of the exciting events that we organize together with Gogla on the 31st of May and the 1st of June in Kampala, Uganda. It will be a very engaging, interactive 2-day event where we completely focus on solar PV and how to unlock the potential and the capital of solar in Africa. And we will give you an unparalleled opportunity to gain insights in solar and to strengthen your business and your network. There's a lot happening around this event, so feel free to keep an eye on our webpage for updates. If you have any questions also about this event, feel free to reach me or one of my colleagues. And we really hope to see many of you in Kampala on the 31st of May. Then, before we delve into the webinar, some last practical notes. As I mentioned, we will have a Q&A at the end, but also we will have the opportunity, you will have the opportunity to answer or to ask questions that will be answered by the presenters after the webinar. We will make a written answer sheet, so we will make sure that all your questions will be answered. So please use the question box, which you can find in the side of your screen. And if you have any technical issues, also use the question box. If you have technical issues about the question box, you can also, of course, send us a brief message, for example, per email, and we will keep an eye on this. In addition, there's also a availability to receive the presentation slides and the full recordings. You will receive an email with instructions how to download these slides and recordings within a couple of days after the webinar, so you can have a look at your own pace. Then I would now be happy to start with our first presenter, Farhan. Could you turn on your camera and microphone, Farhan?
Hi, Ramses. Can you see me and hear me okay?
Yes, perfect. Thank you. Thank you. So great to have you here, Farhan. Pleasure. You are Farhan is working at IRENA, the International Renewable Energy Association, in the position of Associate Program Officer. And as you can see, Farhan has a wealth of experience within renewable energy finance, as well as energy consultant. So we're really pleased, Farhan, to kick off this segment series deep dive with you. Happy to hear what you will be speaking about, and happy to give the floor to you as well. We will start your presentation with a poll question. So all the attendees have the opportunity to answer the following question. Would you like to read out the question, Farhan, to give the word to you?
Sure. Thanks a lot, Ramses, and good afternoon, everybody. Thanks for having me here. So yes, just before I dig into the presentation, two quick poll questions for you. So the first is, about $500 billion were invested in renewable energy globally in 2022. What percentage was invested in solar PV? So we've got a couple of options, 40%, 50, 60, 70%. So that's the first question. And okay, so 40% and 60% seem like the more popular answers. And then the second question is related to Africa. So about $2.8 trillion were invested in renewable energy between 2000 and 2020. What percentage was invested in Africa? Okay, so less than 1.5% seems like the most popular answer. Great. So I'll be touching on the answers to these questions. I think most of you were spot on, but I'll be touching on these a bit more as I go through my presentation. So without further ado, I'm very excited to be here and to be presenting to you the findings of our report on the global landscape of renewable energy finance, which looks at some broader investment trends in the sector. Next slide, please. So in the last 3 years, the renewable sector has faced a number of headwinds in the form of supply chain disruptions, macroeconomic pressures, and rising geopolitical tensions. However, with continued policy support and the existing momentum behind renewables, investments have continued to grow, and in 2022, as the poll mentioned, they reached a record high of almost $500 billion. However, at IRENA, we also conduct a yearly modeling exercise as part of our World Energy Transitions Outlook, which shows that these investments make up less than 1/3 of what is needed annually between now and 2030 in order to be in line with the goals of the Paris Agreement. Next slide, please. So looking particularly at what's driving these investments, the recent surge is led mainly by solar PV and onshore wind. Solar PV in particular attracted around $300 billion in 2022, which is about 60% of all investments. So most of you were spot on in the poll. This has, of course, been accompanied by substantial cost declines over the last 10 years, particularly for utility-scale solar PV. And as a result, you can see in the bottom chart that the world is installing more solar PV capacity each year than it did in the previous year. There is also a growing pipeline of solar projects in Africa, as we see, particularly through independent power producers, as many countries have set ambitious targets and enacted policy mechanisms such as feed-in tariffs, auctions, etc., that are driving deployment. But in 2022, the Sub-Saharan Africa region attracted just 3 billion in solar investments. Now that's still a large amount, but a tiny fraction of the global pie. So much more investment is needed in the region to one, realize its enormous solar potential, to satisfy its growing energy needs, but also to fuel socioeconomic development, which is one of the benefits of renewable energy, as we showcase in our renewable market analysis for Africa, which I'll present in the next slide. Next slide, please. So last year, we launched our renewable market analysis for Africa, which highlighted this disparity in investments. It shows that over the last 2 decades, the Africa continent attracted a little over 2% of global investments. So again, the poll was spot on. And looking at the country level, these disparities become even more evident. So we see that only 4 countries made up 75% of overall investments between 2010 and 2020. This market analysis also looks at the possible socioeconomic impacts of deploying more renewables in Africa. And so I highly recommend, if that's of interest, that you check it out on IRENA's website. Next slide, please. So, as mentioned, while investments are rising globally, the story is really of increased concentration. China, US, and Western Europe are the major players driving these investments, while as we see other regions, such as Sub-Saharan Africa, are taking in just a small fraction. In fact, when we looked at LDCs, the data shows that they have attracted less than 1% of overall investments since 2013. And since the pandemic, investments have either stagnated or are on a downward trend. This just goes to show that while we talk about achieving a just and inclusive transition, we are very far from it at the current moment. Next slide, please. So turning our attention to who is funding renewables and through what instruments. Globally, the private sector makes up about 75% of overall investments since 2013. For solar, it's even higher at 83%. Over this period, we also see that the debt to equity ratio has increased considerably. This is probably because major technologies such as solar PV are reaching maturity, and we see more large-scale projects which have been able to attract high volumes of debt. Particularly when facilitated by power purchase agreements and feed-in tariffs, which then allow debt lenders to envision regular and predictable cash flows over the long term. But the Sub-Saharan Africa picture, of course, differs from the global picture in a few ways. First, public institutions play a much more important role in Sub-Saharan Africa. They made up 44% of overall investments over this period, compared to just 25% from public institutions globally. And so again, this underpins the very critical role that public institutions and governments play and will play in countries that are economically constrained or vulnerable from the point of view of climate change. We also see larger shares of debt, but also more grants in Sub-Saharan Africa compared to any other region, although the overall volume of grants is relatively still quite small. And finally, we also see a larger dependence on international sources of financing. About 50% of the investment over this period came from international sources, which shows the critical importance of the international community for the region. Next slide, please. In the report, we also look at investments in the off-grid renewable sector. So in our scope, that includes both standalone systems and mini-grids. And we find that public institutions, again, particularly DFIs, really stepped up at a time of crisis. In 2020, as the pandemic exposed companies and households to a range of challenges, including supply chain disruptions, cash flow issues, while households experienced a decline in their real incomes, we saw a slowdown in private investment activity. But at the same time, we saw that DFIs increased their contribution by 67% between 2019 and 2021. Meanwhile, philanthropic capital also continued to play an increasingly catalytic role by providing both end user and enterprise financing, helping bridge funding gaps, as well as supporting broader market development. Next slide, please. So this is my last slide, and in conclusion, the story we have seen so far is one of record high investments, but nowhere near what is needed, and also increased concentration of investments. Many countries, particularly in Africa, remain underinvested, especially where private investors are reluctant to come in, as risks, whether they are real or perceived, might be too high. But we're also at a stage now where broader risks need to be considered that relate to more social, environmental, and planetary factors. So we see that these are often missing from the equation, and this is where the role of international collaboration and public finance is key. And that is something that IRENA is really trying to drive forward with this report and this messaging. DFIs, MTBs, government donors, and global funds such as GCF and the newly established Loss and Damage Fund must step up their support and mobilize more funds, particularly in the form of concessional lending and grants, while continuing to crowd in private capital. Funds then also need to go not just to projects, but to help develop entire renewable energy value chains to support a just and inclusive energy transition. So I'll end my presentation here. Happy to take any questions later on, and thank you very much. Over to you, Ramses.
Yes, thanks so much. Thanks so much, Farhan. Was an insightful presentation, and indeed, as Farhan mentioned, don't forget to send in the questions about topics that Farhan touched upon. I think many interesting points to delve into. Then I'm really proud now also to introduce Patrick from our organizing partner Gogla. Hello, Patrick. A pleasure to see you. Patrick will be presenting, or will be giving an off-grid overview. So happy to give the floor to you, Patrick, for a brief introduction and for your presentation.
Thank you very much, and I hope you can hear me.
Yes, I can hear you.
Thank you very much. And I think to everybody who's listening in today, we are looking forward to unlocking solar capital at the end of May in Kampala. It's been, I think, 3 years since we last had many of you who joined us in Dakar, Senegal, and in that intervening period, we had the COVID pandemic, which obviously set a lot of us back in the work that we do, but we are really glad that the industry is still here and is coming on quite strong. I think as we look forward, to add a little bit more context to some of the data that you've seen from Rena and IRENA, maybe it's good to just also share an appreciation of what we see as an industry. So next slide, please. For many of you who know us, Gogla is the global association for the off-grid solar energy industry. This is primarily focused on the standalone sector, not grid connected or not serving multiple customers, but it's really those technology solutions that are for households, small businesses in standalone applications, and increasingly also into productive use application, healthcare, electrification or energy access for standalone, health education, community facilities, and those types of things. And we've been here since 2012. And I think it's worthwhile to appreciate, if we go to the next slide, what's been the impact of our industry since then. We are all quite familiar with the statistics of over 800 million people initially without access to any energy source across primarily Sub-Saharan Africa, but also Asia. But when you also look at those living with weak or unreliable grids, and I think we see these stories every day from Southern Africa with the cyclone that affected countries like Malawi, and we look even beyond countries that have now full energy access or close to 100%, but you still see communities experiencing hours of unreliable or just the grid not being available, which forces businesses to close or people just to live in the dark early. That we can do something more to make sure we bring everybody to have energy access, but also improve the level of service that consumers and businesses face. So to date, we've impacted 101 million people currently served. And from that, we are seeing about 13.5 billion in energy savings. And this is energy savings coming from replacement of things like kerosene lanterns and whatever else they were trying to use. Petrol generators, diesel generators. If you look even more impressive, because beyond just providing energy access, we are actually supporting lives and livelihoods with over 7.4 billion in revenues that have been generated already. And this was before even we saw the maturation of productive use technologies. 2.6 million enterprises supported, and this 94 million metric tons of CO2 avoided. But this is not our vision, especially when we look towards 2030. We think we can drive additional households and enterprises to have more income. We think we can power up to 2.2 million green jobs directly from the industry. We can see more carbon emissions reduced, and our statistics show that what we can impact the equivalent of about 700 coal plants going offline by 2030 if we can make sure that we bring renewable energy sources to communities across the globe. And we can really do a lot to boost resilience for those at climate risk. And to do this, if we can look at the trends that we've seen, particularly in the last couple of years, which I think is an important context as we look again towards unlocking solar capital. To date, if we can go to the next slide, when you look towards 2030 and you think about where are households and communities going to get their connections, and this is data from work that was done by Open Capital Advisors with the support of the Lighten Global Program, Google, and a few other partners. And you will see that between now and 2030, in terms of the share of new connections that is going to come from off-grid solar versus mini-grid, and this is comparing 2020 to 2025 versus 2020 to up to 2030. Currently, right now, we know in Latin America, about 51% of new connections will come from off-grid solutions. South Asia, the contribution is low, but even looking on to lower, not low, but lower, but even looking beyond till 2030, you see that there will still be, about a quarter of households and communities that are served by off-grid solutions. Southeast Asia, it's a bit lower, but now when you come to Africa, Southern Africa, 40%, West Africa, over 40%, East Africa, a significant percentage, and really just the total, you will see that off-grid solutions, especially if we are working towards making sure we leave no one behind, will have to contribute. Particularly, we look at for the window to 2030, about 41% of connections will need to come from this industry, and that is actually millions and millions of lives. Next slide, please. So we've also started to take a look really because it's becoming much more clearer that beyond just providing basic energy access, if we're looking at the quality of service that is provided to communities, and we've done some work, for example, in India, understanding as they realize they're close to 100% energy access, but the question of the quality of service that households and communities are facing. We are all familiar with the stories in Southern Africa. And for example, right now, rolling blackouts is a daily reality when you're in Southern Africa, and it's not going to change quickly. In India, the statistics there, on a daily basis, you will have maybe 1 hour on the low end, but up to 4 or 5 hours every day with no energy access. And therefore, if we're looking at providing a higher level of energy service so that businesses don't have to close in the middle of the day, you've got to shut down your computers, or you're spending solutions, money with backup solutions, that we need to start thinking about an integrated ecosystem. This is where, for example, low voltage appliances will come in to support what the grid is able to provide, really integrating rooftop solar into an integrated ecosystem, even grid-connected appliances that would have battery backups, and really a grid system, what we call segment 4, that is very interconnected system seamlessly between the grid and what the captive or the rooftop solar is there. So this is, as we are looking beyond just providing energy access, but really enhancing the energy level. Let's go to the next slide, please. And here we're looking now beyond that to now what we are seeing in productive use. We've seen increasingly that as we are providing energy access, the question that we are all asking is, are we just powering lights, but are we also seeing the opportunity to impact livelihoods and drive economic activity? Today, we are seeing some technologies that have fully matured and are being used out there. This would be things like TVs, fans, hair clippers, barbershops, inverters, across many markets. Currently near to market or approaching commercial scale is a solar water pump, refrigeration, paygo, smartphones, and things like that. And then many more emerging sectors. And this really it means we will be able to impact on this question of inclusive development, addressing things like youth unemployment, or including rural, seeing more rural economic growth. Next slide, please. So, and then I think lastly, before we go to now the numbers that we've seen, is this question of climate and climate change. And we know off-grid solutions and renewable that we're providing using solar can and will impact in building resilience amongst the communities that have been exposed to climate change, whether it's unreliable rainfall patterns, being displaced by floods or cyclones or hurricanes, the significant droughts that we've been seeing. And we can really contribute quite a bit to helping those communities adapt to climate change. Next slide, please. So what have we seen in terms of investment data to date? From our data focus just on what we're able to collect, and this is a subset of what we've seen from IRENA, is we've seen about, in the last decade, about $764 million invested, of which 149, sorry, not decade, this was our most recent data from last year, 149 deals, about 53 investors, and you look at the total number of recipients that were invested in. But when we start to slice this data up, if you can go to the next slide, we are seeing the mix between when we look at where this funding is coming in, right? So I think right now we are seeing from last year's data, we were at an all-time high, significant, huge investment, which was quite appreciated. But when you look at the mix between equity, debt, and grants, we see that particularly the type of funding that's needed by small or startup firms remains quite low, $11.2 million out of 746 is a very small size of what's needed. You see, this, a healthy mix of debt has come in, but you'll see in the later data on his slides on who's actually getting that and what it means for the sector. And also equity, which is really important if we're going to help companies access not just the amount of funding they need, but also the type of funding that they need that gives them the long ability and runway to invest in their businesses, grow their businesses, and reach the markets that they are trying to serve. So if you look at the next slide, we see in terms of seed capital has been is where a lot of companies, in terms of the number of deals it's gone to, but the level of investment remains quite small on the seed stage. Startup investment to date it's gone to about 43 companies. But again, I think when we look at the number of companies that are able to get this versus the level of investment, we continue to see a high level of concentration in the investment that's been coming in, which is a challenge. And this is something, if we're going to make sure that we have access to finance for everybody in all the markets that we need to, this is something we need to address. I think the last slide before I conclude is looking at the investment raised by segment over the years. Again, you'll see if you compare in the seed stage, it's really very small compared to where we are seeing investment into the scale up. But if we're going to get more companies coming in and make sure that as we are seeing more companies come into the space and able to access the type of funding that they need at the early stage, this is, I think, a challenge that we are seeing. If we look at the line on grant also, this is something that we do need to find and mobilize much more investment, because all the other deals are enabled by those initial investments. So I think as my last slide will really put everything into context. If you compare the investment that's been realized to date in the sector, which is about 3 billion, versus the amount of investment we actually need, this really pales. And this is a huge question that we need to really raise and have with all the partners, from mobilizing public investment, mobilizing development partner or low-cost capital, and then also commercial investment into the space, considering our ambition is to impact 1 billion people. This really pales, and we really need to do what we can to sensitize and increase the investment into the space, and also make sure that the companies that need this investment are able to find and talk to the investors that they need to. And we hope that as we welcome you to Kampala, that you'll be able to join us in this journey. Thank you very much.
Thank you. Thanks a lot, Patrick. Thanks for sharing the challenges and opportunities and your and Gogla views in the off-grid segment, and also the future outlook. And I think a very striking image to conclude with, the gap between investment realized versus investment needed. So thanks for sharing. That's my mouse. Thanks for the presentation. And now I'm really happy to introduce Abraham, the communications director at AMDA, the African Mini Grid Developers Association. Also really proud to say that AMDA is one of our advisors for the event as well, so really closely working together, and it's a pleasure also to have you presenting today here, Abraham. As we can see, you are a really seasoned communications expert, also with a lot of experience at the UN World Food Programme and AgriFin, mainly focusing on digitalization and digital transformation. I'm really keen to give the floor to you, Abraham, and to hear your presentation on the mini grid developments. So the floor is all yours.
Thank you so much, Ramses, and hi everyone who's joined us today. It's a pleasure to be with you. My name is Abraham Dacia. I work for the African Mini Grid Developers Association as the Communication Director. The AMDA is an industry association that speaks for the mini grid developers in Africa. And right now, AMDA is charting the roadmap for the sector in order to ensure that the over 600 million people in Africa who are under energy poverty have access to electricity. Mini grids are electric power generation and distribution systems that supply electricity to small localist group of customers, and they are very imperative to the UN's SDGs. Most mini grids that are built in Africa use solar PV technologies, and right now we know that they are very key, especially also towards climate change initiatives. So we look at the next slide that takes a rough insight on how investments are playing out in the sector. So where are we right now? $2 billion have been committed to build mini grids by 2020. We know only 297 million have been disbursed. That's 13% of them. We also have commitments from other donors, but it's becoming very slow in the sector, especially release of funds. Okay, just 1 second. Ramses?
Sorry, Abraham, can you repeat the question?
Okay, fine. I just realized I had the wrong slides. Let me just pull the right slides. So let's go ahead. So when you look at investment,
sorry, Abraham, go ahead.
So when you look at investments in the sector right now, we have 21,500 mini grids that are connecting 48 million people at a cost of $29 billion. This is globally. In terms of what's planned, we have 29,400 mini grids. 95 of them are in Africa and South Asia, and these are actually expected to connect more than 35 million people at a cost of $9 billion. In terms of donor commitments, we have 2.6 billion committed for mini grid development by donors. Major donors are the French Development Agency, the Africa Development Bank, FCDO, Islamic Development Bank, GIC, and the World Bank. So when you look at also the investment trend since 2013, over $500 million have been committed in the sector by the private sector investment groups. But where do we need to be in order to close the energy access gap by 2030? We actually need around 217,000 solar powered mini grids, and this will cost around $1.7 billion. But it's not only mini grids, we also need to ensure that the market is actually being financed. And for us to ensure that mini grids are actually achieving their full potential, we need to finance them very well and focus on scale. According to the African Mini Grids Developers Association, it takes between 40 to 60 mini grids in a country to reach profitability in a market. This shows that we need to focus on scale, because scale is the single most factor to ensure that mini grids are actually reaching their full potential. And also, as we focus on scale, it's the only guarantee that will ensure that we are able to kind of have lower prices for end customers, especially in Africa, where we are serving a very price sensitive market, that in case of any slight increase in prices towards tariffs, the people who are under energy poverty will have to choose between their basic needs of electricity. And this is the danger of sliding us back to the business issue, whereby we continue without electricity. We also need to transform productive livelihoods and improve business viability. Ultimately, it's the productive use of energy that will guarantee the success of mini grids. And this is a ripple effect. And it calls for energy programs to be coordinated with rural investment programs such as agriculture, irrigation, commercial and industrial usage, because as we have this productive use of energy, it ensures that mini grids are able to gain some money that they can be able to reinvest and grow the sector. We also need to enact regulations and policies that empower mini grid companies and customers. Remember that the African market is a slow machine, it's highly regulated, and we need the governments and regulators to ensure that they have capacity to be able to approve mini grids to the tune of hundreds, so that this can be able to guarantee scale. Right now, based on the Africa mini grids benchmarking report, it takes approximately 51 weeks to go through regulations across the continent, and this is very frustrating, especially to developers. So the next slide, we look at the technology. So the technology in the sector is really promising. It's actually taking the direction of Moore's law, whereby as advances and innovations grow, the prices are falling, and this is good for the growth of the sector. We know that we have smart technologies in generation, distribution, and metering, which is actually increasing efficiency of mini grids and providing better services to end users. We also have emerging innovations in energy storage and end user capacity. Right now, the new batteries store more power and last more cycles at lower cost per cycle, and this is able to fulfill that key KPI of mini grids that provide stable, reliable electricity to its customers. We also have extensive cell phone infrastructure, and this has actually enabled pay-as-you-go metering and new business models. We've also seen smart grids that include remote and internet-based kind of real-time monitoring that's able to dispatch loads. And this is very key because it is the groundbreaking technology that's actually behind the innovations in the mini grid sector. A look at the game changers, what's happening in the industry, or what needs to be done to ensure that we are able to grow the sector and be able to realize the full potential of the mini grid sector. We actually need PPPs and concessions. As I said earlier, the market is very risky, and we need to unlock concessional capital so that we are able to de-risk the market and ensure that developers and investors are able to release their funding. Right now, especially in West Africa, we've seen governments moving towards a more robust PPP structure, and this is really good for the sector. Also, as concession flow into the sector, it provides security and stability to the market, and it guarantees that the sector is going to scale. And as we scale, we have a guarantee that we are going to access more people who are under energy poverty, the electricity that they need. We also need regulations for scale, as mentioned earlier. We need regulators to up their game, ensure that they are able to approve mini grids to the tunes of hundreds, and as fast as they can. This will enable developers to be able to construct and build more mini grids. And as we build portfolios for mini grids, we are able to realize their full potential. We've also seen tenders and concessions coming, and as they take foot, they catalyze and shift this towards a higher scale of mini development. The other component that we need subsidies in the sector. We know that all over the world, electricity is highly subsidized, and the beauty, especially for this region, we've seen over the last 5 years, that there's growing consensus that consumers cannot bear the full cost of burden of electricity. So we need subsidies and more diverse subsidies that should support and lower consumer tariffs, while cost of service pricing is guaranteed. As I said earlier, the Sub-Saharan Africa market is very price sensitive. Developers cannot be able to scale if the kind of tariffs they're going to charge will not enable them to grow their scale. But again, you live in a market whereby customers are very sensitive to a slight increase of price. They are going to make a choice between their basic needs and the electricity. And so without subsidies, this is going to be a scenario whereby we are going to remain locked in that energy poverty and will never be able to scale. We also need to be able to close the gap that's there in terms of equity access. Right now within the sector, investors can access capital to the tune of 1 million, perhaps $5 million US. But we also know that outside there's capital to the tune of $50 million. So these investors want to scale, find themselves in a valley of death because there's no one to be able to bridge the gap between 5 million and 50 million US. And so you find that they can't be scaled. Without scale, we can't be able to access the over 600 million people in Africa, the electricity they need to be able to kill and end the energy poverty. So thank you. That's the end of my presentation. Back to you, Ramses.
Thank you. Thanks a lot, Abraham. Thanks a lot about showing how to scale up the mini grid sector and some of the challenges that we are seeing. Great, it was a great overview. So thanks. Questions are also still coming in, so feel free, as we mentioned already, to keep asking questions to Abraham about the mini grid presentation or about previous presentations. We will try to answer some at the end or after the webinar. But great thanks for this, Abraham. Then I'm now happily announcing Charlotte Taylor from GDC, the Global Distributors Collective. Hi, Charlotte. Pleasure to see you. Also one of our very appreciated partners for the event. So Charlotte, happy to give the floor to you and to hear what you will be speaking about in the context of last mile distribution.
Thank you very much, Ramses, and yeah, it's great to be here today, so thanks for having us. So yeah, I'm Charlotte Taylor and I'm the Communications and Impact Manager at the Global Distributors Collective, or GDC as you may know us by. So the GDC is hosted by Practical Action alongside strategic and implementing partner BOP Inc. And we're dedicated to supporting last mile distributors to improve their business performance and grow, and also to developing the last mile distribution sector as a whole. So next slide, please. Let's kick off by taking a closer look at last mile distributors, or LMDs, and how they add value to the off-grid solar sector. So distributors specifically target consumers at the last mile who are often rural and low income to ensure that they do not get left behind. And they go where others do not because it's expensive and logistically challenging to serve these consumers, who are therefore often overlooked by the mainstream private sector. Distributors focus on quality and develop consumer support services like after sales and consumer financing, and help to open up and strengthen new markets, for example, by conducting market awareness activities on lesser known products. And as you can see on the screen here, last mile distributors sell all kinds of products that contribute to the SDGs, with around about 3/4 of GDC members selling off-grid solar lights and home systems. Thank you. So with that context, and kind of for those of you who maybe aren't as familiar with the GDC, we'll have a quick look at the profile of GDC members specifically. So we have almost 200 members operating across 58 countries, with nearly 80% based in Africa. Members sell a range of products, with 68% selling more than one product category. The most dramatic trend in evolving product baskets that we've seen has been the growth in the number of distributors selling productive use technologies. So this includes things like solar water pumps, refrigerators, etc. And that's up from 6% in 2019 to 35% in 2022. The vast majority of GDC members sell direct to consumers through sales agents, but nearly half sell through retail. And the same also sell through community channels like schools, health clinics, cooperatives, etc. Most GDC members are fairly established, having operated for on average 6.8 years. And GDC members have each reached on average 217,000 people to date, 69% of whom live in poverty, on less than $3.20 a day, and 80% are rural. And nearly all our members offer after-sales service, and more than 3/4 offer consumer financing. And lastly, over 3/4 of our members are local companies. So in other words, they are wholly owned or partially owned by people from the countries or countries in which they operate. Okay, so let's move on to look more specifically at trends in access to finance. So according to our latest GDC member survey, 62% of members have raised at least one kind of funding since 2019, with 46% having raised grants, 33% having raised debt, and 21% having raised equity. But nonetheless, access to finance is consistently cited as the key barrier to growth, particularly for local last mile distributors. But fortunately, we are seeing more fit for purpose solutions emerging, and funders are increasingly recognizing that profitability is not always linked to scale. There are different growth models and profitability models requiring different investment instruments. So as you can see from this quote, funders like Acumen are rethinking how they deploy capital to focus on replication of smaller companies, not just on scaling a handful. And this idea that small companies can represent a sustainable path to last mile energy access is also supported by GDC research, which we will take a closer look at now. So we've previously introduced the terminology of faster growth and slower growth last mile distributors based on companies' average growth in annual revenue. And we found that there's a correlation between companies' expansion strategies and their fundraising journeys. So at this point, I should just flag that this is a very high-level whistle-stop tour of a much more in-depth piece of research that's available on our website, and I'll drop the link in the chat box shortly. So faster growth last mile distributors are typically focused on quick geographic expansion. They funded growth primarily with equity at all stages, and these companies in our sample had collectively raised 16 times more capital than their slower growth counterparts. This group represents about 7% of our membership, and a couple of companies that fit in this category that you may know of include Zonfor Energy in Zimbabwe and Easy Solar in Sierra Leone. Slower growth distributors are typically focused on sustainability before expansion. So most of these companies have funded their development with grants and growth with debt. They haven't raised as much equity. Despite having raised little capital overall, however, these companies tend to be less capital intensive than their larger, faster growth counterparts. They operate leaner structures and achieve 33% more revenue per dollar of capital raised. This group represents 93% of our membership. And again, Bidasasa and DivaBits Green Energy are a couple of examples operating in Kenya that you might know about. Okay, so 3 key points to take away from all this. Sorry, back to the previous slide. Both slower and faster growth last mile distributors are crucial to reach underserved customers at the last mile. LMDs tend to focus on profitability before growth, which has helped them to grow more organically and sustainably. And despite often being overlooked as too risky a prospect, they are investable businesses, with GDC members alone having collectively raised over $220 million and having reached over 40 million last mile consumers to date. Next slide. So building on this research, last year we interviewed over 50 funders to map the last mile distribution capital continuum. So on the screen here, you can see a visual summary of the various funders that we mapped and spoke to that are investing in distributors at different stages of the journey. So again, this is a snapshot of a much more comprehensive piece of research, but 3 key points to take away from this. Firstly, as Patrick said, more capital is needed across the board, so from pre-seed to Series A and beyond. While it's difficult to quantify the finance gap at each stage of the capital continuum precisely, what we can say is that the gap is particularly apparent for slower growth last mile distributors, who, as we've just seen, constitute more than 90% of GDC members and who are particularly in need of early stage equity funding and smaller working capital facilities. So currently just 22% of the funders that we spoke to provide these kinds of finance, including players like Charm Impact, Elia, Beneficial Returns, and so on. And finally, on the faster growth last mile distributors, our assessment, I think, aligns with Gogla's again. So these companies are lacking equity to continue in their growth trajectory, so post Series A, and have the capacity to borrow increasingly significant amounts of working capital. Next slide. So just quickly, what is the GDC doing to help finance flow into the LMD, the off-grid solar LMD sector? So we're working to bring investors together, for example, at our annual last mile distribution investor forums, and also developing practical ways to better enable the sharing of market intelligence between investors. We're also supporting investors to design funds that are better suited to distributors' needs. And really importantly, we're working directly with distributors themselves to help them get investment ready. For example, we recently launched a set of 3 investment readiness tools for early stage distributors. And we also work with companies to connect them with funders directly, which we do in a number of ways, including via an online funding database for last mile distributors, which is on our website. So I really hope that this has given a high level but interesting insight into the last mile distribution finance space, and do get in touch if you'd like to know more about us, or if you'd like to work with us on any of our upcoming access to finance activities. Back to you, Ramses.
Points in last mile distribution. Really interesting to hear about this, and of course to what is needed to achieve universal electricity access. Then I'm also, we're now moving towards the last presentation of this webinar. I'm happy to now give the floor to Paul, who will be speaking on behalf of the Association for Electric Mobility and Development in Africa about the driving forces around electric vehicles in Africa. So Paul's Operations Director at AMDA, and again, also really working with AMDA on this topic about e-mobility also at USC Africa. So Paul, I'm giving the floor to you now. Happy to, excited to hear about your presentation.
So my name is Paul Meyer. Just to let you know that we are in the process of rebranding, so we shall be known as African Mobility Alliance. Previously, we were known as the Association for Electric Mobility and Development in Africa. In our rebranding, our key focus area will involve around supporting policy development through local associations. Basically, we'll be providing them evidence-based policy that they can be able now to lobby at the local level. Another thing we'll be looking at is events. So here we'll be looking at convening all key stakeholders, from investor working groups, from industry working groups, just to help, especially fill the knowledge gap and facilitate capital investment in the sector. Next slide, please. So this is just a snapshot of an investment, current investment in the e-mobility in Africa. So this is a research that was conducted last year, Q4 2022, and we were looking at 7 countries spread within East Africa, West Africa, and Southern Africa. And it's quite interesting to note that as of last year, let's say December, we're looking at 78 million deployed in space. This represents like, an opportunity for people to enter the space. It's quite worthy to note that Kenya alone represented almost within this research focus area. Also, looking at the investment within Kenya alone, which is also more than 50% of the total that was raised there. So then the whole idea around why Kenya seems investment compared to other countries was because of various factors that we're looking at. For example, the policy enabling environment, ease of doing business. So, for example, note like Kenya had the ease of doing business was quite welcoming for many investors compared to some of other African countries, and that made a lot of investment into the country. Also, you'll notice among these 86 companies, majority, I think close to 90%, are in the two-wheeler business. So this is mostly because of the upfront cost. It's quite cheaper to roll out electric two-wheelers compared to four-wheelers. But in Kenya, we have I think two electric bus company, trying to roll out public transport as an alternative, the diesel. Next slide, please. So this is just some interesting developments within the space. There's usually a debate: do we go the charging way, do we go the swapping way? And depending on a company business model, one could go the route of charging, and another company would go the route of swapping. Both have their pros and cons. So, for example, if a company was to go the swapping way, that means they need to deploy a lot of capital when establishing the swapping infrastructure, and also they get to own the battery themselves. It's a win for the consumer because they don't need to buy the batteries because they can basically swap. It's more like batteries from the swap providers, and also this presents an interesting opportunity to power this swapping station with renewable energy, which can also help reduce the cost, the operational cost of running the swapping station. And also that presents an opportunity, especially for mini grid developers who are struggling to make the mini grids viable. They can be able to have that extra power to charge these batteries within the rural areas and help them recoup some of that investment that was there. Also, key thing to note around whether it's charging or swapping, especially on the battery chemistry and the lifetime of the battery, is quite critical that companies are aware of, what is the chemistry that they're bringing on board. For example, LFP is quite favored by most companies because of, it has a longer life cycle, which can be quite applicable for swapping because you don't want to be replacing batteries now and then. So you want batteries that can run, let's say, between 10 to 20 years. Yeah, thank you. So I think that's just to give a snapshot.
Thank you. Thanks a lot, Paul. Thanks for showing these trends in e-mobility. Also interesting to see indeed these differences in charging and swapping and how they affect the different segments. So really interesting to end on this note. I would like to thank all of you. Actually, it has been a really great presentation. So if everybody could, all the speakers could turn on their video. Would like to really thank everybody for participating. As we mentioned, we will be sharing the slides as well. And as we promised, there would be a Q&A, but I'm very aware of the time here. So I think what we will do is we've gathered all your questions. We will share them with our speakers afterwards, and we will make sure that all your questions are answered written. There's quite some interesting ones, so we can compile a really interesting wrap-up report about this webinar. Last thing that I wanted to share for everybody that is still with us, we're also happy to share and to facilitate your presence at USC Africa. So for all the attendees that were here today, we are sharing with you a 15% discount, which applies to you whether you're an international or a local company. It's a 15% discount for your access ticket to Unlocking Solar Capital Africa on May the 31st and June 1st, where you will be hearing about these topics amongst many others. But once again, a great thanks to today's speakers, and I wish you a very pleasant afternoon and rest of the week.